1st January 2013 bar 10,000 bar purchased, and in the second line 30% per annum. Straight line method, SLM. This is the short form of straight line method. In the next line, 31st December each year. Suppose this is the question. I have made the outlines of this question. It means the machinery has been purchased on 1st January 2013. On 31st December 2013, you will provide the depreciation 30% of 10,000. That will be 3,000. In the next year, as on 31st December 2014, again you will have to provide depreciation, and that will be 30% of 10,000, rupees 3,000. In the next year, as on 31st December 2015, again you will provide the depreciation, 30% of 10,000, that is 3,000. It means every year the amount of the depreciation will be 3,000. If you plot it on the graph, you will find the straight line. That's why it is called straight line method, and sometimes it is called equal installment method, because every time the amount of depreciation, I am to say annual depreciation, is 3,000. So that's why it is called equal installment method. And every time you are calculating 30% of 10,000, 30% of 10,000, it means every time 30% of the original value of the machinery. That's why it is called original value method. So till now, we were doing our questions on the basis of original value method or straight line method. There is one more option, one more method of providing depreciation. Suppose this is the question. 1st January 2013 bar purchased bar 10,000. In the next line, 30% per annum bar reducing balance method. In the next line, 31st December each year. What it means? On 1st January 2013, a company purchased machinery for 10,000 and the depreciation is provided at the rate of 30% per annum, but on the basis of reducing balance method. It's a new thing for you, and the books are closed on 31st December each year. Now it's a new thing for you, reducing balance method. In this situation, let's make a table to explain this thing. I'm going to make one vertical box. In the first column, this is the date. In the second column, this is the value of machinery. On 1st January 2013, the value of machinery was 10,000. Then on 31st December 2013, the depreciation will be provided at the rate of 30% of 10,000. That will be 3,000. So 10,000 minus 3,000 and the net value is 7,000. It means the value of the machinery as on 31st December 2013 is 7,000. Then come to the next year, 31st December 2014. The depreciation will be provided 30% of 7,000, not 10,000, because the last available value was 7,000. So in reducing balance method, the depreciation is provided on the reduced value, not the original value, and the reduced value is 7,000. So 30% of 7,000 is 2,100. So less depreciation 2,100 and the net value will be 4,900. Then comes the next year, that is 31st December 2015. So you have to provide 30% of 4,900. That will be equal to 1,470. So the net value will be 3,430. Now come to the next year. On the day of closing, the depreciation will be provided 30% of 3,430. That will be 1,029. Be careful. If you find the value of depreciation in paise, means not in rupee, you will have to convert it into the rupee, because the depreciation is not provided in fraction of rupee. So in this way, the net value will be 2,401. So if you notice at this table, In the first year, the depreciation was provided 3,000. Then next year it was provided 2,100. Then next year 1,470. Then next year 1,029. Means the value of depreciation is going down and down every year. That's why it is called reducing balance method, and it is also called diminishing balance method, and sometimes it is called diminishing value method. So whatever you want to call, but one thing is clear, that the amount of depreciation will go on reducing every year, because the depreciation is provided on last value, not the original value.